Welcome back. Reducing your tax bill puts more money in your pocket. Joining us today is certified public accountant Minna Huang to share some simple tips to reduce your taxes. Minna, welcome to the show.
Hi, Sybil. Thanks for having me.
So everyone wants to save taxes if it means they get to keep the money to spend on things they want to spend it on. What are some common ways you suggest people can reduce their taxes?
Well, a big tip for me is to make use of your RSP, your Registered Retirement Savings Plan, as well as your TFSA, your tax-free savings account.
What's the difference between the two?
Good question. So your RSP, as the name implies, is more geared towards your retirement savings. There's a big tax benefit with having an RSP, and that being is that when you contribute to your RSP, you get a tax deduction on your tax return. On the opposite side, though, is that when you pull funds out of your RSP in the future, you'll have to pay tax on those funds. But the good thing is that if you pay tax in the future, when say maybe you're retired, you're not working, your income is probably going to be lower, which means you'll probably pay lower tax as well.
And along the way, your money will continue to grow tax deferred, and it will compound at a much faster rate because you're not paying taxes on that every year along the way, are you?
Correct. That's a great benefit of the RSP. For the TFSA, it's a little bit different. It is still tax deferred in the sense that the money in your account is growing without having to pay tax on it. But the difference from the RSP is that your TFSA is contributed using after-tax dollars. So this would be income that you've earned and already paid tax on. Then you put that income into your TFSA. The good part, though, as the name implies, tax-free savings account, is that when you pull money out of your TFSA, you don't have to pay tax on it.
Oh, I like the sounds of that. Let's talk about really then the tax saving implications of the TFSA. So compared to not putting it into any type of a special account, if I invested $10,000 into a tax-free savings account and I earned a 5% rate of return that year, walk me through how that works.
Well, for your tax-free savings account, that 5% that you're earning in that TFSA, that's not going to be subject to any tax. So your $10,000 will grow at 5% every year. And when you pull that money out, you're not going to have to pay any tax at all. On the flip side, say if you put it into a non-registered account, just a regular investment account, that 5% is going to be taxable to you every year. So that's a huge benefit of your TFSA, is that you don't have to pay tax on the income that's earned, versus in your non-registered account, that's an income inclusion every single year.
Right, and for someone in a top tax bracket, that 5% they earn, 2.5% may go to the government, and they only keep 2.5%. So by putting it into your tax-free savings account, you keep the full 5%. Well, this sounds a little too good to be true. There must be some limits on this. Or can I put everything into that?
So every year, CRA sets an annual limit that you're allowed to contribute to your TFSA. This can change every year. It gets adjusted for inflation, but you can't just throw all your money into TFSA, because that would be too good to be true.
Okay, so what happens if you make a mistake? What happens if you put too much money in because you forgot to check what your limit was?
So that can cause big issues with CRA. If you put too much money in, CRA will charge you a penalty. The penalty is currently 1% of the amount that you've over-contributed, and that's 1% a month. So it can really add up.
That's 12% a year. I might not make that much money in terms of rate of return on my portfolio. So the government would make more money than I would.
Yes, you'd be losing money.
So is there a way to unwind it? Like, people must make mistakes. What do you do if you catch yourself in that situation?
Yeah, it happens. We deal with it all the time. People do make mistakes. So the best thing is probably to just pull it out as soon as you notice that there's an issue, to prevent that 1% penalty from occurring each month. You can also speak with your financial advisor as well as your accountant, and they can help you. Sometimes, CRA says, you made a mistake. It's okay. we can let you go. But if it's been occurring multiple times, maybe over multiple years, there would be some paperwork to file with CRA as well as the penalty to pay.
I don't think they let things go too loosely. They want to get their fair share. Okay, so if I have built this up over a number of years and I withdraw some money, can I put that money back in again at a later date?
Yes, but it has to be the following year. So if you pull money out of your TFSA, that's completely fine, but you can't put the same amount back until the following year, because that is when your contribution room, your limit refreshes itself.
Great. So the RSP, you put money in, you get a tax reduction right away, so you might have some little extra money in your pocket. Maybe you put that to the TFSA. The TFSA, you put money in, but you save taxes every year on the gains that you make in that account. Minna, thank you so much for sharing your tips with us today. It's been a pleasure.
Thanks, Sybil.